Preemptive Infrastructure Theory, RWA Tokenization and the Great Unlocking of Legacy Capital. Introduction. In every era, certain visionary efforts appear premature, until suddenly they aren't. They begin as quiet groundwork, dismissed as overbuilt or unneeded, only to later reveal themselves as the foundation for entire revolutions. This paper introduces Preemptive Infrastructure Theory, PIT, a strategic lens through which to understand how seemingly early-stage investments in infrastructure can yield compounding, asymmetric value over time, while simultaneously providing present-day utility and monetizable outcomes. Unlike moonshots that defer returns far into the future, PIT-aligned projects are grounded in an essential duality. They function today and leverage tomorrow. They produce ongoing cash flow or strategic advantage in the short term, yet unlock vast optionality, use cases, beneficiaries, or economic layers that only become visible downstream. Nowhere is this more clearly emerging than in the world of real-world asset, RWA tokenization. Whether it's the $100 billion plus stablecoin market providing liquidity and yield, or the nascent push to tokenize physical and analog assets trapped in garages, warehouses, and family vaults, this movement signals a turning point. Tokenization is not just financial innovation, it is the digital reclamation of dormant capital. In this exposition, we explore how PIT applies to tokenization, classify the key RWA categories, analyze historical precedents, Google, stablecoins, and propose a framework for understanding why some infrastructures fail while others quietly reshape the future. We call this arc the Great Unlocking of Legacy Capital, a shift already underway with trillions in potential upside. Section 2, Theoretical Foundation. What is Preemptive Infrastructure Theory? Preemptive Infrastructure Theory posits that some of the most transformative technologies and systems are built before their ultimate purpose is fully understood. They are constructed not in response to current demand, but in anticipation of future value that can only be realized once the infrastructure itself exists. The critical nuance of PIT is this: these projects are not moonshots. They generate ongoing value from day one through revenue, utility, or strategic advantage. But that near-term return is only a fraction of their true worth. PIT infrastructure accrues second and third-order effects over time, enabling downstream innovations and entirely new industries that would otherwise be impossible. Core tenets of PIT. 1. Foundational infrastructure. The work lays the groundwork for future layers: data, financial, technical, legal. 2. Early monetization. The system must generate revenue or functional utility today to sustain itself. 3. Future optionality. Its greatest value is hidden at inception and only surfaces later as use cases compound. 4. Coordination layer. PIT infrastructure often functions as a standard or platform that enables others to build atop it. Historical examples. Google's scanning and indexing of books and web pages seemed excessive at the time, until it fueled search, ads, and later AI. TCP/IP and HTTP protocols created the internet before e-commerce, social media, or mobile apps were conceivable. In crypto, stablecoins and tokenized treasuries are yielding value now, but may underpin global settlement systems later. PIT offers a way to explain both the foresight of builders and the blindness of markets. It helps us see why something like Bitcoin, which seemed like a toy in 2010, could become a trillion-dollar monetary asset, and why many ICOs or memecoins that promised the future failed. They had no present utility and no infrastructure to support downstream growth. With PIT as our lens, we can now examine how real-world asset tokenization fits this pattern, and why it may be one of the most important infrastructure plays of our time. Section 3, Case Study A, Google's digitization of knowledge. In the early 2000s, Google undertook a massive and seemingly quixotic mission to scan and digitize millions of physical books, articles, and analog documents. The initiative, which culminated in projects like Google Books and Google Scholar, was criticized as unnecessary, overly ambitious, and legally complex. But this quiet, methodical work, cataloging and structuring the world's analog knowledge, was not simply an archival effort. It was preemptive infrastructure building. At the time, the monetizable value was already clear. Google's core business model was based on search and advertising. The more content that was digitized and indexed, the more search queries could be monetized, and the more relevant the advertising became. In this way, the effort paid dividends early on, but its greatest value came later in ways few could have predicted. It created an unparalleled corpus of structured human knowledge, which would become foundational for training AI models and LLMs. It surfaced lost and obscure works, enabling new research, innovation, and insights in the digital humanities and sciences. It standardized metadata and categorization frameworks that now inform everything from knowledge graphs to academic citation engines. Google's scanning wasn't just about preserving the past, it was about structuring it for future intelligence. In PIT terms, this was a classic infrastructure play, foundational work, converting unsearchable analog knowledge into digital form. Immediate monetization, search and ad revenue. Future optionality, training data, AI systems, semantic web, predictive search. This example is critical because it reveals how digitization plus indexing plus coordination, three hallmarks of PIT, can unlock latent value no one knew was there. It also sets the stage for understanding RWA tokenization. Where Google digitized human knowledge, tokenization is digitizing human capital and value, physical, monetary, and legal. Let's turn now to the most successful and active example of tokenization today, monetary RWAs. Section 4, Case Study B, Monetary RWA Tokenization, Stablecoins. The most successful and visible manifestation of real-world asset tokenization today is stablecoins, blockchain-based tokens pegged to real-world currencies, typically the US dollar. At first glance, stablecoins may seem like a simple concept, a one-to-one digital wrapper for fiat, but under the hood, they represent a monetized, composable financial rail and a masterclass in preemptive infrastructure theory. Present-day utility, monetization in action. Stablecoins offer immense, immediate utility. Liquidity layer for DeFi. Stablecoins are the primary medium of exchange and collateral in decentralized finance. Remittances and settlements. Near instant, low-cost global transactions without intermediaries. Dollar access in emerging markets. In countries with volatile local currencies, stablecoins provide a financial lifeline to USD-based saving. Treasury yield harvesting. Issuers like Circle and Tether park reserves in short-term U.S. treasuries, generating billions in passive yield, making stablecoins some of the most profitable crypto instruments today. Stablecoins already represent over $150 billion in market cap, and that number is projected to grow into the trillions as regulatory clarity and institutional adoption accelerate. Infrastructure foundations. Stablecoins didn't just happen. They required banking relationships and real-world custody, oracles and attestation mechanisms, smart contract infrastructure across blockchains, liquidity protocols, exchanges, and cross-chain bridges. These systems constitute a monetized infrastructure layer, a digital foundation that already delivers value while setting the stage for far greater impact. Exponential future optionality. While stablecoins are already profitable and useful, their pit value lies in the future. Global payment standard. They could become the preferred settlement layer for fintech, commerce, and even interbank transfers. Regulatory convergence. U.S. congressional bills and Europe's MiCA framework are giving stablecoins legal structure and legitimacy. Gateway to tokenized treasuries and CBDCs. As stablecoins normalize tokenized money, they pave the way for other financial instruments to follow. Just as Google indexed human knowledge, stablecoins are indexing and mobilizing global money, digitally, transparently, and programmatically. In the PIT framework, stablecoins are a near-perfect case. Present monetization, high. Coordination layer potential, massive. Second-order effects, composable finance, tokenized capital markets, embedded payments. Next, we explore a more speculative, but no less powerful, use case for PIT, the tokenization of physical RWAs, also known as legacy capital. Section 5, Case Study C, Physical RWA Tokenization. Beyond stablecoins lies a vastly underexplored frontier, one that may hold even more untapped value. The tokenization of physical, real-world assets, or what we now refer to as legacy capital. These are assets with intrinsic worth, some generational, some industrial, that are currently trapped in analog form, hidden in basements, vaults, attics, warehouses, and legal frameworks. These include luxury collectibles, watches, cars, jewelry, rare wines, fine art and antiques, real estate, residential, commercial, or land, industrial equipment, vehicles, inventory, intellectual property rights and licenses, estate and trust-held wealth. Individually, these assets may be idle. Collectively, they represent trillions in latent global capital. The PIT opportunity, value reclamation via digital coordination. Just like Google scanned books to unlock hidden knowledge, physical RWA tokenization aims to structure, index, and digitize dormant value. This involves appraisal, verifying authenticity and market worth, digitization, creating tamper-proof, transferable digital representations, custody, vaulting or registering the asset with legal clarity, tokenization, issuing fractional or whole digital ownership, coordination, integrating into smart contracts, marketplaces, and financial systems. Once tokenized, these classical assets can serve as collateral in DeFi or TradFi systems, be fractionalized to expand market access and liquidity, become programmable and traceable, facilitating royalties, lending, and dynamic ownership. Present utility, just beginning. Unlike stablecoins, the monetization layer here is still early stage, but visible. Real estate tokenization is underway, e.g., PropChain, Roofstock, Homebase. Luxury collectibles are entering fractionalized investment platforms, e.g., Masterworks, Rally. IP tokenization is starting to show promise for media and biotech assets. The rails are being laid. Appraisal standards, custody networks, and legal wrappers are forming the necessary infrastructure for the exponential phase to begin. Future upside, the great unlocking. As tokenization matures, legacy wealth becomes liquid and mobile. Capital previously locked in physical assets can be leveraged and reinvested. A global value layer emerges, where tokenized assets flow like information flows today. This is the preemptive infrastructure moment for legacy capital. The assets are real. The value is already there. What's missing is the infrastructure, and it's being built now. In the next section, we'll examine what Pitt tells us about why so many speculative projects and tokens fail, and how this framework can help us avoid past mistakes while identifying future winners. This content is brought to you by Bobby Giggs. Promote your brand here and reach a wide audience across platforms like YouTube, Instagram, and Facebook. Follow the links in the description to get started. Section 6, What Pitt Explains About Failure. Not all ambitious infrastructure projects succeed. Many well-funded initiatives in the crypto space, especially during the ICO boom of 2017-2018 and the memecoin frenzies of 2021-2022, burned bright and fizzled quickly. What preemptive infrastructure theory gives us is a filter to distinguish foundational efforts from speculative noise. The key difference? Utility today, optionality tomorrow. Most failed projects had neither. The ICO era, hype without infrastructure. Many ICOs sold the promise of a decentralized future, but failed to launch functioning products, generate user adoption or revenue, build real infrastructure, or even protocols. These projects weren't building rails. They were selling maps to fictional gold. Without a monetizable base layer or a clear path to compound utility, they collapsed under the weight of their own hype. Meme coins. Speculation without substance. Meme coins like Doge, SHIB, Pepe, and others had virality, but no underlying asset, no economic function, and no coordination layer to build upon. They thrived in liquidity-fueled mania, but their fates were tied to sentiment alone. In Pitt terms, meme coins and most ICOs lacked both short-term monetization and long-term optionality. They were built neither to survive nor to evolve. Why this matters for builders and investors. Pitt becomes a due diligence lens. Ask, does this protocol or token offer real utility today? Ask, is this infrastructure others can build on? Ask, if this succeeds, does it unlock second or third order effects? This applies retroactively too. Bitcoin was seen as niche until its properties made it sovereign digital collateral. Ethereum offered nothing more than programmable contracts until DeFi, NFTs, and L2s emerged atop it. Stablecoins seemed redundant until they became DeFi's monetary foundation. Understanding why projects fail is just as important as knowing why others succeed. Pitt helps us categorize both. Now that we've explored failure modes, let's formalize a taxonomy for tokenization, how we can better classify these assets, their role in infrastructure, and how they fit into a maturing market structure. 7. Toward a taxonomy of tokenization. As tokenization matures, so must its language and structure. For the ecosystem to scale beyond enthusiasts into institutional capital, regulators, and legacy markets, we must move beyond buzzwords and into precision. Preemptive infrastructure theory helps us here by pushing us to ask, What type of asset is being tokenized? What infrastructure supports it? What stage of maturity is it in? This section proposes a clear classification framework to organize real-world asset RWA tokenization efforts, separating hype from substance and identifying where PIT-aligned value is most likely to emerge. Two primary classes of RWA tokenization. Let's take a moment to look at this structured breakdown of RWA tokenization through the lens of preemptive infrastructure theory. We're looking at two distinct groups here, each representing a different category of tokenized assets, both vital to the future of digital finance, but at very different stages of maturity. First group, monetary RWA tokenization. In the first group, we have monetary RWAs. These are fungible financial assets like US dollars, treasuries, and gold, now being represented in tokenized form. Examples include USDC, USDT, tokenized treasury products, and gold-backed tokens like PAXG. These assets already deliver high present-day utility. They power trading, provide liquidity in DeFi, enable remittances, and, critically, allow issuers to earn substantial yield from treasury holdings. This is mature, revenue-generating infrastructure. From a PIT perspective, this group is a validated success. The infrastructure is not only functioning today, but is becoming the foundation for future global payment systems and settlement rails. It is monetized now, and its optionality is expanding. Second group, physical RWA tokenization, or legacy capital. The second group represents what we call legacy capital. These are non-fungible, physical, or analog assets, things like real estate, fine art, collectibles, machinery, and intellectual property. These are assets with real, often substantial value, but that value is trapped in analog form, largely illiquid and underutilized. Right now, the utility here is early stage. You're seeing appraisal platforms, fractional ownership models, and some niche marketplaces emerging. But the infrastructure is still forming, particularly around legal wrappers, custodianship, and valuation standards. What makes this group exciting and PIT relevant is the scale of what's possible. This is the great unlocking. Trillions of dollars in idle global capital just waiting for a coordination layer. The groundwork is being laid right now, and the future payoff could rival or exceed what we've seen in the stablecoin and DeFi markets. So, to summarize, the first group is already delivering profitable, regulatory progress, and critical to DeFi's foundation. The second group is emerging with massive latent value and growing infrastructure readiness. Both are PIT-aligned, but they represent different risk-reward profiles and require different strategies from builders, investors, and regulators. And that's the framework. Monetize today, coordinate the future, and build infrastructure that pays back twice, now and later. Subcategory labels for physical RWAs. Different contexts benefit from different language. A mature ecosystem allows for narrative-flexible, audience-specific framing. Now, let's shift our focus from asset classes to language, specifically how we name and frame tokenized physical assets. The table you see here introduces subcategory labels for what we've broadly called physical RWAs, but as this market matures, we need more refined and context-sensitive terminology. This isn't just semantics, it's positioning, communication, and strategic clarity. First label, analog RWAs. This is our technical term, neutral and accurate. It's ideal for use among developers, protocol designers, and infrastructure teams. Analog helps emphasize the transition from physical or paper-based value to programmable digital form. Second label, legacy capital. This is a financial and generational framing. Best used when speaking to family offices, estate planners, wealth managers, or institutional investors. It signals heritage, long-held value, and the potential for unlocked liquidity and reinvestment. Third label, classical assets. This term evokes prestige and cultural capital. Think of use cases in art, collectibles, vintage items, and luxury asset platforms. It appeals to an audience that values provenance and wants the gravitas of traditional wealth paired with the innovation of tokenization. Fourth label, vaulted value. This label emphasizes security, custody, and hidden worth. Most appropriate for custodians, insurers, and asset protection use cases. It's metaphorical but intuitive. It conveys that what's locked away physically is now becoming accessible digitally. Why this matters. In a maturing ecosystem, language creates structure. It tells regulators how to categorize, tells investors how to price, and tells users what kind of value they're interacting with. So we don't need one name, we need the right name for the right context. That's how we build the taxonomy that can scale with this opportunity. Visual framework. The classification chart we previously created maps these categories across two axes: present-day utility, low to high, future optionality, low to exponential. This helps investors, builders, and regulators triage attention and capital while also locating where infrastructure is being over or underbuilt. In the next section, we'll tie this all together, exploring what PIT means for investors, developers, and policymakers, and how to identify which tokenization efforts will compound into the infrastructure of tomorrow. 8. Implications and opportunities. Understanding preemptive infrastructure theory doesn't just help explain the past, it sharpens strategic focus for those building and investing in the future. In a noisy, hype-driven landscape, PIT is a compass. It orients us toward foundational work that delivers real-world utility now while unlocking massive potential later. For builders, designed for immediate use, a working MVP that solves a real problem today is worth more than a white paper promising a trillion-dollar market. Structure for composability. If others can build on top of your infrastructure, you amplify downstream effects and increase your odds of becoming indispensable. Lay rails others can ride. Tokenization protocols, data registries, and appraisal oracles may seem mundane now, but they will be the highways of Web3 capital. Think like Google. Index the world's value now, even if you don't yet know what the queries of tomorrow will be. For investors, use PIT as a filter. Favor projects that show real traction and monetizable infrastructure, not just narrative appeal. Look for dual-layer returns. The best opportunities pay off in two waves: short-term revenue, long-term protocol leverage. Back builders laying ground for others. The unseen infrastructure, legal wrappers, compliance rails, custody standards, often becomes the bottleneck for multi-trillion-dollar markets. For policymakers and institutions, don't fight the inevitable. Tokenization is a digitization wave as inevitable as the internet. Support standards and clarity. Regulatory frameworks like MiCA or U.S. stablecoin bills don't just allow innovation, they unlock institutional participation. Participate early. Central banks, sovereign wealth funds, and pension systems should treat stablecoins and tokenized RWAs as infrastructure, not fads. Let's take a look at this final table, the strategic arc. What you're seeing here is the three-phase progression that underpins most successful tokenization efforts aligned with preemptive infrastructure theory. This isn't just a workflow, it's a strategic roadmap for builders, investors, and policy leaders alike. Phase 1, digitization. This is the raw conversion layer. We're taking analog assets or records and transforming them into a digital format. In the context of tokenization, that could mean scanning property deeds, registering ownership of art, or encoding gold reserves. The PIT implication? No infrastructure is possible without this first step. Digitization is what makes value machine-readable and ready for coordination. Phase 2, indexing. Now that the asset is digital, we structure and organize it. This includes assigning metadata, valuations, legal rights, and market classifications. Think of Google organizing books into searchable libraries. Here, we're doing the same with physical capital. PIT insight. Indexing makes assets visible to systems and markets. This is what enables discovery, price formation, and interaction. Phase 3, coordination. This is where real infrastructure is activated. Smart contracts allow for lending, trading, and governance. Assets can become collateral, fractionalized, and embedded into larger protocols or financial systems. This is where composability enters the picture and where exponential value starts to compound. Pitwise, this is the moment when previously passive capital enters the digital economy. Final takeaway: digitization creates access, indexing creates visibility, coordination creates value. Understanding this arc helps us diagnose where a project is, what it needs next, and how far along it is on the PIT maturity curve. This arc echoes through every PIT example, from Google to stablecoins to legacy capital tokenization. The playbook is the same: do the hard work now, monetize along the way, let the future show up when it's ready. Up next, conclusion. Conclusion. The future will thank us and pay us for it. The most powerful infrastructure is built before its necessity is fully apparent. It is laid in advance of demand, not recklessly, but with conviction that digitization, standardization, and coordination will eventually unlock value far beyond what is visible today. This is the heart of preemptive infrastructure theory. We've seen this pattern before. Google didn't know it was laying the foundation for LLMs. TCP/IP's architects didn't know they were building the groundwork for trillion-dollar internet platforms. And today, the builders of tokenization infrastructure, whether working on stablecoins, oracles, legal wrappers, appraisal standards, or NFT-linked deeds, may not yet grasp the full scale of what they're enabling. But they're doing the work anyway. The key insight of PIT is this: you do not need to wait 20 years to realize value. The best infrastructure pays dividends today and creates irreversible optionality tomorrow. This dual-layer return is what makes PIT-aligned efforts so economically and strategically potent. Tokenization, especially of real-world assets, RWAs, is the PIT arena of our time. Monetary RWAs, like stablecoins and tokenized treasuries, are already revenue-generating engines and programmable financial rails. Physical RWAs, legacy capital, are just beginning to be digitized, but their latent value is staggering. Real estate, art, machinery, estates, IP, this is where the next trillion-dollar unlock will come from. PIT also explains failure. ICOs and memecoins lacked utility. They didn't coordinate value, didn't enable composability, and didn't offer infrastructure anyone could build on. They were noise, not signal. But PIT-aligned projects don't fade into irrelevance. They compound, they attract builders, they become the substrate for the next wave. The future doesn't reward hype, it rewards structure. So we build, we scan, we index, we tokenize, we digitize. And when the next wave of demand arrives, when the capital, intelligence, and coordination begin to flow, we'll be ready. The future will thank us. And more importantly, the future will pay us.